Welcome to the sessions. So today we are going to see about the ratio analysis. So first we will see the meaning. What is ratio analysis? A ratio is a simple arithmetical expression of the relationship of one number to another. So here the ratio provides a simple arithmetic explanation. That is from one number to another number, the relation we are going to find out. Okay, so the ratio analysis refers to the analysis of various pieces of financial information in the financial statements of a business. They are mainly used by external analysis to determine various aspects of a business, such as its profitability, liquidity, and solvency. So the definitions, according to Accountant's Handbook by Wixon, Kell, and Bedford, a ratio is an expression of the quantitative relationship between two numbers. And according to Kohler, a ratio is the relation of the amount to another and be expressed as the ratio of A to B and A is to B, then or as a simple fraction, integer, decimal fraction, or percentage. So in simple language, the ratio is one number expressed in terms of another and can be worked out by dividing one number into the other. So ratio analysis, we can do comparison. That is a ratio of other companies, and the trend, it will be ratio at different times. So what is the uses of the ratio analysis? So we will go for the comparison process, and we can analyze for the trend lines, then operational efficiency of the organizations. Okay, so the comparisons, how we can utilize the ratio analysis for doing the comparison process. One of the uses of ratio analysis is to compare a company's financial performance to similar firms in the industry to understand the company's position in the market. So every company, they will do the analysis process, that is comparison process. Okay, so the ratio analysis will help them easily to identify the values in the financial performance. Okay, so obtaining financial ratios such as price earnings from known competitors and comparing it to the company's ratios can help management identify market gaps and examine its competitive advantages, strengths, and weakness. The management can then use the information to formulate decisions that aim to improve the company's position in the market. So second one is trend line. Companies can also use ratios to see if there is a trend in financial performance. Established companies collect data from the financial statements over a large number of reporting periods. The trend obtained can be used to predict the direction of future financial performance and also identify any expected financial turbulence that would not be possible to predict using ratios for a single reporting period. And third one is operational efficiency. The management of a company can also use financial ratio analysis to determine the degree of efficiency in the management of assets and liabilities. Inefficient use of assets such as motor vehicles, land, and buildings results in unnecessary expenses that ought to be eliminated. So financial ratios can also help to determine if the financial resources are over or underutilized. So the ratio analysis, we can categories of financial ratios, that is liquidity ratios, profitability ratios, solvency ratio, turnover ratios, and earning ratios. And the ratio analysis types. Okay, so this chart is explains in detail how what are the ratios in the category wise. So the first one is the liquidity ratio. So liquidity ratio, we can call this a current ratio and quick ratio. And profit ratio also we are having in different categories. That is a gross profit ratio, operating profit ratio, net profit ratio, and a return on capital employed. Then solvency ratio. So solvency ratio having debt equity ratio and interest coverage ratio. And the turnover ratio having fixed assets turnover ratio, inventory turnover ratio, and receivable turnover ratio. And last one is earning ratio. So earning ratio means we are having two categories, that is a profit earning ratio and earning per share. So now we will see the formulas So in the liquidity ratios, we have seen there is current ratio and quick ratio, right? So current ratio means the current ratio equal to current assets divided by current liabilities. Okay, so we need to add all the current assets and current liabilities, then we can calculate the current ratio. So total current assets divided by total current liabilities, we will get the current ratio value. Okay. And next one is quick ratio. So quick ratio means the cash and cash equivalents plus marketable securities plus accounts receivables. We need to add all these three things and divided by current liabilities. Or else simply we can call this liquid assets or quick assets divided by current liabilities. So what are the assets? It will be included in the liquid assets or quick assets means that is cash and cash equivalent, marketable securities, and accounts receivables. So these are all called quick assets or liquid assets. Next category, profitability ratios. So profitability ratio having many formulas, many categories. The major things only we are discussing here. The first one is gross profit ratio. So to calculate gross profit ratio, we need to take the gross profit value and we can take the net sales multiply with 100. So we will get the gross profit ratio. So gross profit divided by net sales into 100. And second one is a net profit ratio. So net profit ratio equal to net profit divided by net sales into 100. And third one is operating profit ratio. Operating profit ratio equal earnings before interest and taxes divided by net sales into 100. And next one is a return on capital employed. So return on capital employed equal to earnings before interest and taxes divided by capital employed. So third one is solvency ratio. So solvency ratio having two major categories, that is a debt equity ratio and interest coverage ratio. So debt equity ratio equals total debts divided by shareholders fund. And next one is interest coverage ratio. Interest coverage ratio equal earnings before interest and tax divided by interest expenses. And next, turnover ratio. So fixed assets turnover ratio equal to net sales divided by average fixed assets. Okay, so average fixed assets that we need to add opening and closing and divided by 2, we will get the average fixed assets. And next one is inventory turnover ratio. Inventory turnover ratio equals cost of goods sold divided by average inventories. And next one is receivable turnover ratio. Receivable turnover ratio equals net product sales divided by average receivables. And fifth one is earnings ratio. So earnings ratio having two categories, that is profit earning ratio and earning per share. Profit earning ratio equals market price per share divided by earnings per share. And second, earnings per share equals net income minus preferred dividends divided by weighted average of outstanding shares. Here's some examples of ratios used in financial analysis. Okay, so there are several hundred possible ratios that can be used for financial analysis, but only a small core group is typically used to gain an understanding of entity. So these ratios include the following. So first one is maximum the company they are using the current ratio. Okay, so the current ratio compares current assets to current liabilities to see if a business has enough cash to pay its immediate liabilities. And second, day sales outstanding. So it determines the ability of a business to effectively issue credit to customers and be paid back on a timely basis. Third one is a debt to equity ratio. So it compares the proportion of debt to equity to see if a business has taken on too much debt. And next one is the dividend payout ratio. So this is the percentage of earnings paid to investors in the form of a dividend. If the percentage is low, it is an indicator that there is room for dividend payment to increase substantially. And gross profit ratio, so calculates the proportion of earnings generated by the sale of goods or services before administrative expenses are included. A decline in this percentage could signal pricing pressure on a company's core operations. And next, inventory turnover. So it calculates the time it takes to sell off inventory. A low turnover figure indicates that a business has an excessive investment in inventory and therefore is at risk of having absolute inventory. Net profit ratio, it calculates the proportion of net profit to sales. A low proportion can indicate a bloated cost structure or pricing pressure. So price earning ratio, it compares the price paid for a company's shares to the earnings reported by the business, and exclusively high ratio signals that there is no basis for a high stock price, which could presage a stock price decline. Return on assets calculates the ability of management to efficiently use assets to generate profits. A low return indicates a bloated investment in assets. So the calculation of current ratio. So this ratio is calculated by comparing current assets with current liabilities. So we can take, for example, the current assets of a concern as rupees 2,50,000 and current liabilities as rupees 1 lakh. So current ratio will be calculated as follows. So the formula to calculate current ratio is current assets divided by current liability. So here the current assets value is 2,50,000 and the current liabilities value is 1 lakh. So we are getting 2.5 is the current ratio. So the current ratio of 2.5 means that current assets are 2.5 times of current liabilities. So this ratio can also be presented as 2.5 is 1. In current ratio, current liabilities are taken as 1 and current assets are given in comparison to it. So that's all about the ratio analysis. Thank you for all.